Here we go, Quasar Markets. Kevin Green from Schwab Network. Y'all watch him all day long. Talk to me a little bit, Kevin. What's going on in the markets, my man?
Well, right now, I mean, obviously we hit that 6,000 level, so that was a key milestone for us to try to recover and get back to these levels, obviously after the lows that we have seen. But we have been kind of gyrating a little bit over the last week or so, Stephen, and I think that's for a couple of reasons. One, starting getting to that summer season. So we have the seasonality effect where we have lower volume, maybe a little bit lower liquidity, more compressed markets. But I also think that we're also waiting on the news items to kind of hit the wire, really trying to solidify where are we going next when it comes to the trade wars and the trade tariffs. Also looking at the budget and tax policy, how that's going to impact yields, especially on the longer end of the curve here. And then what are we looking at when it comes to inflation and the labor market? So there's a couple of different components, but I think we're kind of in that lull state. And honestly, it's nice to kind of digest, but you also kind of you got to keep your head on a swivel here. We did the same thing in January. For January to about mid-February, we were gyrating around that 6,000 level until we broke. So this is kind of those. We're in that kind of environment right now.
You know, it's interesting that you say that. And I've been saying this for a while, that your charts are useless when Trump tweets. Your charts are useless when these big news articles are pumping out left and right, especially in this what I guess Jeremy was saying earlier is the liquidity zones. What are you seeing in the markets? What's the thought process behind the institutional levels? Because they're not thinking like retailers right now. They're thinking a little bit longer term, right?
Yeah, they are. So a couple of different dynamics that I think are very important for people to kind of understand. What I look at is the VIX curve itself. And the VIX curve is actually normalized until you get to around October. Then there's a little bit of a kink within that curve. Be mindful of that. It's probably because we're trying to price in a rate cut around September or so. Yeah. So that's one thing to be mindful of. But when you're looking at the VIX spread between the VIX minus the front month VIX future, or even if you go to the second month that is out there, we're actually in a really nice normalization, but we're in actually a one standard deviation move to the downside. And we've been like that for the last 6 days. And we usually do not stay at those levels for too long. Actually, the last time that we did this was around September. We had 7 trading sessions where we were at these just extreme lows when it comes to the volatility curve itself. We're kind of in that same environment. And volatility, it doesn't take really much to actually re-rate that higher. And so that's where I think that there's still a little bit of a risk out there. From an institutional standpoint, you still are seeing the collars being put into place, selling upside calls, buying downside puts here. But you're starting to see more and more upside calls being layered into the market, and also stock replacement strategies or risk reversal strategies, if you will. Selling puts, buying calls, utilizing that leverage or that premium in order to get some upside potential. And so that's kind of where we are at right now. There is going to be a point when we break, it's not an if, eventually we will get to new all-time highs. When that does happen, you actually do generally see institutional dollars that have been on the sidelines being committed a little bit more in the markets as well. So that could actually create, you have a little bit of a neckline, a resistance level. We have a breakout to the upside. Those additional asset dollars on the sidelines can also come in and kind of create a little bit of a catalyst. So I think that's the bull thesis there. The bear thesis, in my opinion, is that we are kind of setting up for a small pullback over the next 2 weeks. And I think that the June monthly expiration, or the quarterly expiration, if you will, probably would be the perfect environment for that to be able to happen because of the gyration and positioning from institutional traders.
Yeah. Oh, wow. It's the quad wishing days. We looked the scary time. Okay. If that's the case, you just blew your minds of most retail traders who are just naked calls and naked puts. What would you say to them that what is it, the clarity that you need to see in order for the retail to start pulling the trigger? Because they're already pulling the trigger left and right, and they're causing a little bit of this back and forth that the institutions are going, or whatever. So what do they need to be thinking about here in the next few weeks?
Yeah, I think, retail's been killing the game. So you got to give it to them. Basically, since those lows, they have been, 35 to 40% of total buy flows in equities have been from retail, which is remarkable. We usually don't see that. So they've been on the right side. I think if you're trading the options, though, Continue to look at your weekly charts. The weekly chart still tells you that there's going to still be some upside moves. So when I say that there's going to be a pullback, I don't think it's going to be a long and pronounced one. I think it's going to be one of those sharp 2.5%, 3%, maybe even a 4% pullback. We recollect and continue to move higher. In that type of environment, you want to just buy a little bit more time instead of maybe buying the 0 DTE or maybe the week out. Maybe go out 2 weeks, maybe go out 3 weeks, because the goal when you're going long premium, no matter what, long calls, long puts, is obviously you want to have realized vol being more and moving more in your direction than the premium that you're paying. And the problem that you have right now, just like we talked about, a gyrating market will burn premium away. So you could also look at selling premium too. The problem that you have with selling premium in this environment, just talked about, volatility is actually really low to the downside. So could you scalp premium and sell premium? You could. But I would be very careful with selling downside premium or the put side, because this re-rating, and I feel like it will happen. It will eventually happen where the VIX will re-rate. I think that would be fairly aggressive, and that can blow you out of your position. So if you buy 2 weeks out, go out 4 weeks. If you buy 4 weeks out, go out 6 weeks. Give yourself a little bit more time. The primary trend is still to the upside here, but you got to be able to try to combat maybe the theta decay. You can also look at diagonal spreads or calendar spreads. I actually like diagonals a little bit more. So buying long calls or buying longer dated calls, selling near term premium against it. You can do the same thing on the put side, vice versa. That's also something that's been working pretty well here. And if you wanted to get really complicated, we could talk about ratio spreads. I don't think we want to get down that route.
I love that.
But ratio spreads right now in this environment is also really decent, because you have a primary move to the upside. You can see what the trend is. You have a very low volatility market. Premiums are relatively cheap. So let's say you do a 3-to-2 or even a 2-to-1 put call ratio spread, 2 calls, 1 put. Skew to the upside here, but if you get a 4%, 3% pullback, that put can offset some of that premium on the call.
And what Kevin's talking about, for those people out there, ratio spreads, meaning it's not 1-to-1. Now you buy 1 call or 1 put. It's buying 1 or 2 more, or 2 more to the put side, 2 more to the call side. So there's a ratio in between there. All right, let's get right to it. The bromance, I think, is officially over between Elon Musk and Donald Trump. Let's talk to me a little bit about that bromance. It's feel like putting on some old 1990s records and crying in the rain, right?
It's nothing more satisfying than seeing 2 grown men, billionaires, going back and forth on social media. Obviously, that was a big headline for last week. I think as markets always do, we tend to overreact. Tesla had a pretty decent overreaction, and I'm still keeping my eye out on this because it did actually move higher towards the end of the day. President Trump provided some commentary. You did see some buyers stepping in. If we do see a continued breakdown in Tesla, the 250 level is actually very key, because that's where I saw a lot of put action. Basically, on that Thursday, was it Wednesday, Thursday, Friday, or that Thursday, Friday, or what have you? The put action was definitely there. So you actually do have a structural level at 250 for Tesla. That should be a decent area of support here. But once again, this is one of the most actively traded equity names within the option space. So you could look at, obviously people are swinging this every single day. But I think you're going to see things calm down. They both have things to lose right now. And I think, unfortunately, it was an aggressive thing that did happen. There's not a lot of people, and I'm not trying to be political, this is just kind of a fact. There's not a lot of people that stay within Donald Trump's orbit for too long in the political sphere. At some point, they kind of get burned out and things readjust. And I think that's exactly what happened here. It's an unfortunate situation, but I think if you look at the long term, maybe for Tesla, you will have some fundamental impacts. And I got to highlight this too. They were talking about, there was this narrative of, oh man, the EV tax credits are going away. I don't know about you, Stephen. I've been pricing in EV tax credits going away ever since we saw the landslide victory in November. I don't know if the market was really pricing in that that we were going to continue to keep those EV credits. But I think you get the concern of maybe slowing the regulatory approval for robotaxi and autonomous driving. Maybe LiDAR technology, Waymo gets a little bit more favorability. I think that was the bigger risk.
But they pushed the envelope a bit with Epstein Island. They pushed the envelope a little bit. I'm going to rip off all your SpaceX rockets. No more use of that. It got a little deeper than just I don't like you anymore. You're not in I'm not swiping left for you anymore. So. Yeah. It seems to be a little bit deeper than that. Am I missing the mark on that?
No, you're right. I mean, words were said, and you can't. I mean, it's so funny too because Elon's deleting all of these things. So it's like, dude, everybody looks at your account.
Platform, right? I guess.
Yeah.
Okay, yeah.
But I go back to saying they both have things to lose. We're not going to utilize your rockets anymore. Guess what? There's nobody in the United States right now, no company that is able to backfill what SpaceX is doing. We gave Boeing a shot, and they epically failed and left some astronauts out there. So what are we going to do without SpaceX? We're going to ask Russia, which we're kind of in a pseudo black ops covert war with them right now. So once again, overreaction, words were said, but if you kind of go back and you look at it and you say, well, what are you going to do? You can't leave the people in the ISS. And that's why Elon backed that off too, because you can't leave them stranded either. And then worst case scenario, the U.S. can take over your company. U.S. can take over any company here in the United States if they feel and deem that they need to do so for national security. And I think, once again, cooler heads will prevail. Let's see how the Epstein thing, I'm not going to go too far into it. Curveball.
Yeah.
And I'm not sure if that you can come back from that one, but it seems like they're going to try to gloss over it a bit.
It's interesting when you look, we talked about it from the institutional side. We talked about it from the retail side. How do you protect that portfolio? And we just had Peter Thomas on, the Mr. Gold himself. Talk to us a little bit. What are you seeing in the gold, silver, platinum market right now?
Yeah. So, it's silver's time to shine. Gold's doing its thing. But, when you look at the gold market, everybody wants what happened to gold happen for it to happen to silver and platinum and plate, and that's just not the case. Okay. Gold really ripped because of that physical short squeeze and the adjustment when it came to actual physical bars being moved from London here to the United States. When you had that type of reaction, you had institutional traders that were literally tendering up their short positions at the CME to try to deliver to their customers that wanted to have the physical bars. Was that happening in silver? It was. Was it happening in copper? It was. Not as aggressively as gold. And then also you kind of have this backing off a little bit of this trade war for now. So gold had a phenomenal run, and you can't really fade gold, in my opinion. You can't really fade gold until it breaks below its 20-week moving average on the weekly chart for gold. So it hasn't done that. It's leveraged that as an area of support, and until it does that, I think you still got to say that's going to consolidate and move higher. Silver has been in a structural deficit for years. Yeah, for years. But it's an industrial metal first and a precious metal second. And there is always a catch-up trade once we start the end of one cycle and going into another one where silver does outperform. And if you are an equity bull, you want to see silver completely smash gold because it's an inflationary measure, it's an economic growth measure. But that is something that when you look at that gold to silver ratio, the outperformance in equities, and everybody uses it. Platinum, palladium, two other items here. Platinum and palladium, both of them have been structurally shorted very aggressively by managed money for damn near 10 years now. So you are getting a little bit of a bid there. Be careful with those two metals because they will move, and they are moving right now, and you are seeing it squeeze. But the depth of market on platinum and palladium is not that much. The average retail, 98% of retail traders out there are not trading platinum and palladium straight up because the margin requirements like 80 grand, 85,000 for one contract. It's really aggressive, very thin markets. But you are seeing a squeeze there. I think there's also this notion that ICE vehicles, maybe we see a little bit of a resurgence there. There is a blockage of platinum exports from Russia. So there's some structural thing. And then you have the squeeze happening as well. So there's a structural area that's happening within platinum and palladium. Just be very careful Those market, I don't trust those markets as much as I trust the silver or gold or copper market, just because it's very thin and it's 90% of those traders are institutional traders that are hedging books.
Yeah, and
So,
I just got
really
back
good movement.
from Vegas from the 2025 Bitcoin conference. Talk to me about Bitcoin. It seems like we're pushing higher again, almost 109 now.
Yeah, if the Bitcoin can continue to move, look, I don't follow it too much, but if
Okay.
Bitcoin can continue to move higher, I look at Bitcoin as a liquidity measure. So as it continues to move higher, I think it just shows that there's more liquidity in the market. Every time that we have an event and Bitcoin moves in one way or another, it's either a store of value one week, and then it's a risk on sentiment indicator the next week, and then it's a hedge for the dollar the next. And it's like I don't even try to pick those games anymore. I just
What's
look
the
at it and say,
story
hey,
behind Bitcoin
yeah,
today, right? The
if
last
it's
5
going
minutes.
higher,
Yeah.
if it's going higher, I think equities probably are going to be moving with it.
We have a very slow week news-wise, and this is what you do the best at Cabin. Talk to me. What news are you looking for? What econ data point are you looking for? What kind of Fed speak? What is it that you're looking for this week?
Well, I don't think I think the Fed speakers are going to be on a blackout period.
They
If
are
I'm not
actually. That's right. You're right.
mistaken.
Yeah.
So, okay, so if you're looking for a big risk event day, I think Wednesday is the day. So if I'm going to put my alarm bells on, if I want to put my caution tape around, my keyboard here, Wednesday is going to be the day. You have core CPI, you got headline CPI coming out. Market is expecting month over month to get a little bit hotter. This should be the first print that we have the full impacts of tariff policies being implemented here. Kind of talked about as well. I think I talked about this, but you have a situation where energy prices have moved a little bit higher.
Yeah.
Gasoline's up 7% or so
Yeah.
in that May month. Diesel's up as well. Natural gas prices still elevated. Utility prices have already been a point. Then you start wondering, okay, well, what's happening with the payroll? Do we start seeing these pricing pressures for shipping start to actually being reflected? So that's where your big risk event is. That being the case, Cleveland Fed is completely disconnected from the estimates of the street. Cleveland Fed is pretty good. They rarely ever miss.
Yep.
And so if they are right, you expect that CPI actually comes in lighter than the street's expectations, which I think would be a bull event. I personally, and I want to make sure I'm very clear, I personally think that CPI does come in a little bit hotter. But if I'm looking at the trade setup and I'm looking at the macroeconomic data, you go to the Cleveland Fed now forecast and you look at it, look at their track record. Let's say we have a pullback tomorrow going into that event. If let's say we have a pullback, 0.5% pullback tomorrow, 0.25%, whatever, still low volatility. Going into that event, if the Cleveland Fed does not readjust those estimates by tomorrow, I would think that's actually more of a bull on.
Yeah, and it's a great point, Kevin. People don't understand that Loretta Mester is no longer there. It's Beth Hammock, and she's been spot on with inflation. And I think a lot of people think that inflation has been pushing up, and then of course, the loss of jobs that narrows it down to stagflation. But I think you're right. I think inflation is coming down, and I think the president is banging the head of Fed Chair Powell. How is this going to play out? Are we going to get this cut? That I mean, my God, yesterday, Trump said he wants a full 100 basis point cut. I don't know what he wants now. What's he wanting here?
Yeah, I think inflation's sticky. I think it's going in the right direction, but I still think it's going to be sticky. I think that there's still going to be some summertime risk, and there's some of that is going to be seasonal as well. So I think that there is some risk there, and then tariffs will, I think, will cause inflation in some respects. But you are not seeing the cracks of the labor market quite yet. ADP is a little bit of a concern.
Okay.
The jobs report looked like it's pretty decent. I don't think we're in stagflation yet, but we do have signs if you trust the soft data, which probably should discount the soft data. Here's what the Fed wants. They either want the labor market to crack, or they want the Trump administration to accelerate and figure out and finalize these trade deals ASAP. As soon as the trade deals are finalized here, at least the major ones, the Fed will cut. They'll at least do a maintenance cut. They'll at least do 50 basis points, 25 basis points this year. I think they'll have to do that at least, but maybe up to 50 basis points. But they cannot have the uncertainty of tariff policy. You cut before that, and let's say that the administration completely removes the tariffs away completely for whatever reason. you catch President Trump on a good day. Then you have the fear of like kind of what we experienced during COVID-19, and that's a concern. And the reason why I bring that up, shipping rates and shipping volumes reflect the gyration and the uneasiness, and that's not good. From over importing in Q1, and which created the negative GDP, to now our GDP estimate is sitting at like 4.6% in Q2. We have now a reacceleration. You have shipping prices going higher. LA ports are looking okay. They're starting to see some normalized behavior after about 2 weeks of really anemic activity here. You cannot have that back and forth for the economy, especially on the shipping side. So I think the Fed's going to say, hey, dude, figure out the tariff, we'll cut, or you need the labor market to cut. I think it's too early for PCE to be the driving indicator for them, at least for another 3 months. And then you have this curveball of potentially a shadow Fed president. And I don't know how the Treasury market's going to be dealing with that.
I like that. All right. Yes or no? Are we in a recession?
Yes.
Ooh, I like that. Because to me, I think you're right. I've been saying it for a while. Auto delinquency rates are at an all-time high. Housing market's not good, and people are losing jobs. I agree. Kevin Green, Schwab Network. I'll see you right back here next week. Thank you so much for being on Quasar Markets Live.
Appreciate you having me.